So the patent box was introduced originally in 2013. There are lots of equivalent regimes around the world. So there are innovation boxes, knowledge boxes, patent boxes. And the UK went for a patent box because the thinking was, well, a patent is something where you get an external office, like a patent office, to say, yes, you've invented something new, as opposed to a company sort of saying, I'm sure I've invented something good, and trying to convince a tax authority. If it's a patent, well, there's some external validation that you've invented something good. And the idea is it's an incentive for innovation, as in companies that create patents are doing something innovative. That's the kind of thing that the UK as a developed economy should be doing. Therefore, we want to incentivise companies to do more of that kind of activity in the UK. And possibly that's where the problem started with the patent box, but we'll return to that concept of attracting people into the UK. The way the patent box works, at the moment, the corporation tax rate in the UK for a company, 20%. Patent box originally sort of designed to basically halve that rate, give you a 10% rate. And it does that by saying, well, your profits from your patents will tax at 10% as opposed to the 20% rate on everything else. But this is the tax system. We're tax people. We don't do things in a straightforward way. So we see a loss as a good thing. We see having a bad year as a good thing because it means you don't pay tax. And we can't just say, well, apply a 10% rate. You get an additional tax deduction to get you to the 10% rate. So if you think about a normal UK tax return, you start with your accounting profit and you knock off various things, and one of the things under the patent box you do is get an additional deduction for your patent box deduction to get you down to an effective 10% rate. Rather like when you do an R&D tax credit, you knock off some enhanced R&D losses before then surrendering them to get cash. So that's the way the concept works. And the aim is to say, well, if you've got a patent, you make extra profits. You make more profits than you would have done if you hadn't got a patent. That's the idea. You can command a premium in the market because what you're offering people is something that has something novel about it that is patented that others don't have. That economic super profit is what gets taxed at the 10% rate. And there are mechanisms we'll see to get rid of other bits that are not patent related. They still get taxed at the 20% rate. What's left is effectively taxed at the 10% rate. That's the concept. So as I say, it's patents and similar assets. I think for most people in this room, we're looking at patents. There are other similar things to patents which again have external validation on them. What it doesn't cover, being patents, is it doesn't cover copyright. So for example, software companies, if they haven't got things that are patented, they've only got copyright, they can't claim patent box benefits. And it doesn't cover US patents. So you need a patent that's granted in the UK or the European Economic Area, because those are what's sort of accepted in the UK as being things that are new and novel. But US patents weren't included. In the US, it is in theory easier to patent things like know-how, things that look more like a business process. And the nervousness was, well, we want to incentivise innovation in the UK. If we include a US patent, well, that's including other stuff. Every company can argue, well, there's know-how in what we do. I mean, I would argue that in Confluence Tax, there's know-how in how we put a tax return together. Does that mean I could claim under the patent box? No. So it's making sure you just include patents as we understand them in the UK. The way I think about it is that you need to have, on the product you're making money from, you're making profits from, you need to have a European Economic Area patent. That's kind of a qualification to get you into the patent box. Having got in, then any profits in that product, wherever you make them, whether you make them in the US or in the EU or in Outer Mongolia, doesn't matter. You've got your entry by having a European Economic Area patent. Once you're in, you can make your profits wherever you like. And then the tax system, thankfully, is saying we're looking at effectively where economically you own the patent. So you either own the patent or you can have an exclusive license to the patent. So lots of situations where you don't want to have to move the patent, assign it, pay all the re-registration fees. If you exclusively license a patent to someone, the licensee, well, economically they own the patent. No one else can benefit from that patent, so they get the patent box benefit. And the rules are very formulaic, this idea of being formulaic in order to work out, okay, what's the economic super profit? So you start off saying, well, of all my profits, what percentage of that is from is sort of patent-related profit? Now, I think for a lot of companies that we deal with, actually 100% of your income is patent-related. And when we say income, we're talking about you're either selling product or you can be licensing your IP. It's quite broad. There was one awkward situation we had where someone was doing a deal to get where they were getting income from granting an option to acquire IP. So it was an option over IP. I think we had some uncertainty there. I think where we got to with HMRC was it's probably okay, but it wasn't absolutely categorically in the law. But in general, most of the ways in which any company would try and exploit income or earn income, exploit its patents, will be within the patent box in terms of the right type of income. So you then worked out, well, this is a percentage of my taxable profits. I now need to work out, right, what's my routine return, my marketing return? We're stripping out the other bits that make people buy your product. So we've all been in situations where you go to the supermarket, you want to buy some ketchup, you buy Heinz because it's just Heinz. That's what we call a marketing intangible. That's driving you to make that choice. And so we want to take that out of the patent box in the same concept as you might buy something because it's patent protected and therefore commands a premium. So those sort of concepts going on, but it's done in quite a mechanical way in the patent box. And we then say, okay, here's my patent related profit, and there's a formula to turn that into a tax deduction. And that's how you get down to your 10% rate. So that was the situation in terms of working out how the patent box works when it was introduced in 2013. One of the main reasons for doing this seminar is we've got new rules coming in this year, 2016, which basically apply all the old rules, all the formulaic ways of working out what the patent box deduction is, with an additional calculation stuck on the end. Now, the old rules are okay for if you had a company that was already elected into the patent box, or we'll come on to if you're elected in time. You've probably got till the end of 2018 to elect into the old rules. So you're under those formulaic rules. There are new rules coming in, so new companies or new products that come in. You then have all the old calculation plus a new calculation, and this is this idea here of nexus. Yeah. So what's going on here is you've probably all seen in the press all the stuff about companies that are basically multinationals being very, they're shifting profits around to the right tax jurisdiction, be it Ireland, Switzerland, wherever. And there's a general nervousness at the OECD that people are effectively shopping around for the right tax rate. And so the OECD started this thing called the BEPS project, the Base Erosion and Profit Shifting Project. They're looking at where are people moving their profits to get the right tax rate. And one of the measures they looked at was the patent box. They said, well, look, you've got this measure in the UK, Belgium, Netherlands, Spain, that is making people shift their profit into that place, even if economically it may not be justified, or in terms of what boots are on the ground in terms of making that product happen. It might not have been, say, in the UK, but you are able potentially to take advantage of the UK patent box. So the idea was to say, well, what we want to do is tie the company that did the R&D to the income, the patent income later. And the idea is nexus. You need nexus between your R&D activities and the income. Now, you're probably by this stage thinking this is getting quite hard, and you think, well, is all this worth it? I've got all the tax deductions I need, and you think, well, for heaven's sake, for SMEs and small companies, can't we just get an exemption from too many more extra rules? For my sins, I went on behalf of the Bioindustry Association to the OECD in Paris and had a big public row with a German civil servant trying to get an SME exemption. Now, I don't know if any of you have seen the Harry Potter films, but when you look into the face of a Dementor that's trying to suck your soul out, look into the face of a German civil servant, he was just not doing it. It was not going to happen. From his point of view, this was straightforward. Now, I think their mindset was, if you are a German motor manufacturer and you're based in Germany, and all of your profits are in Germany, all your R&D is in Germany, all your income is in Germany, this is straightforward. We have complete nexus between our R&D and our income. This is fine. You then say, and also your turnaround on things is relatively fast. If you then go to the UK and look at the life sciences industry and say, well, your IP is coming in from all over the place. It may move around several different companies, and it may be 10 or 15 years between R&D and final IP income coming in. It's a nightmare to track what R&D gave rise to which income. But this was an OECD project. It had to happen because there was a general consensus that there needed to be change. The UK and Germany then sort of teamed up to work out what that change was. David's been heavily involved in how we actually implement this in UK law. But it does mean, as well as those formulas to work out what's my patent-related profit, you have an additional requirement, which is to work out what's my nexus between R&D and income. And of course, this is tax, so we do it with a formula. This is my version of the formula, because I deal in the very moralistic world. Good spend divided by good spend plus bad spend. Yeah, you multiply your patent box deduction by that number to work out if you get patent box benefit or not. If you've only got bad spend, you get nothing. If you've only got good spend, your fraction is 1 and there's no restriction. So what we're actually looking at is it's your own R&D spend, your internal R&D spend, and any R&D you subcontract out to third parties, divided by the same thing, own R&D spend and R&D subcontract to third parties, plus acquisition costs, so where you bought in some IP, and R&D subcontract to related parties. So where you've done the R&D in-house somewhere else in the group, or you've bought the IP in, that's bad spend. That makes the bottom of the fraction larger, therefore you're restricting your patent box benefit. So that's where this is nexus in terms of saying, how much of my R&D did I do in the company? The problem in the UK, because the way the UK tax rules work, is we're applying this fraction on a company by company basis. So if you've got a group of companies, even if they're all in the UK, you've still got to say, in the company that's claiming the patent box, have we got nexus between R&D activity and the income? So you're possibly now thinking, why do I care? If you're talking about a loss-making biotech company, got plenty of losses, we get extra deductions from R&D tax credits, the chances are the strategic plan is company will be sold before I get anywhere near profits. Why do I want to know about the patent box? Well, if you do have profits, in terms of selling things in the future, then you get a lower tax rate if you can apply the patent box. If you do a licensing deal, as we said earlier, the kind of income that's coming into the company, whether it's IP from selling products, profits from selling products with IP in, or it's profits from licensing your IP, all still qualifies under the patent box. So license deals, we've done this a number of times now, you get a lower tax rate by getting this patent box deduction. But the last two, if you say, well, look, I'm never going to get near income, if you go through a due diligence process, then investors are going to want to understand, can this company benefit from the patent box? Now, you think about doing a discounted cash flow model and saying, what's this company worth? Well, actually, if you're applying a 10% tax rate instead of a 20% tax rate, the company's worth more. And also on a share sale. So if you're selling a company, we've had it already where you've had companies who've been asked on due diligence, okay, you're in the UK, what work has the company done to establish whether they can benefit from the patent box or not? And it is the kind of thing that I think it will be expected that finance people in the biotech will have some understanding of and know whether the company is likely to be able to qualify or not.